And like Roger said, I do mostly M&A work, but I'm a transactional tax attorney. I do a lot of other comp sort of work, and occasionally I get involved in, I guess, more of a controversy type matter. I do a lot of the foreign bank account disclosure work and some other things related to that. But M&A, like Roger said, is a big part of my practice. I do a lot of tax advice for our own law firm, and then other law firms too that just don't have tax attorneys. They'll consult with me on their transactions. So let's get going, because there's sort of a lot to cover, and this is a whole course in law school, but we'll try to cover what we can in 1 hour. So I'll talk about, like Roger said, taxable transactions first, generally, some tax-free reorganizations, and at the end I'll cover some of the compensation and 280G issues. So the first question that I typically face when I'm looking at an LOI or an agreement, a merger agreement or transaction agreement, is trying to determine whether or not this is actually structured as a taxable or a tax-free reorganization. And the way you can typically tell is from one major item, and that's part of the consideration is going to be paid in the form of buyer stock if it's meant to be a tax-free reorg, because that's one of the requirements. So if you have an LOI or a deal and it's all the consideration is cash, it's not going to be a tax-free reorganization. If it's a mix of cash and stock of the buyer, then there's a chance you're going to qualify, and most often you're trying to make it qualify because you don't want the seller to be taxed on non-cash proceeds in the deal. Occasionally you have a public company buyer and they can liquidate that stock and pay taxes, so it might be okay in some rare circumstances. But for the most part, if you have buyer stock in the deal and the buyer is a private company, then you're trying to qualify this transaction as tax-free. So it's really those economic terms in the deal that will sort of set the stage. You also have to look in the LOI for other things that might not even be parts of the transaction consideration. You might have compensation payments woven in. Everyone knows in the Valley the team that works for the company is almost as important as whatever the product or the company has created. And so you'll see a lot of compensation payments woven into these deals as well. And it's a struggle sometimes to even distinguish what is compensation versus transaction consideration. You want to keep that in mind when you're at the initial stages. You want to consider whether you can qualify because, or whether even you want to qualify, because the nature of the certain seller or buyer might make certain transactions work or not work. If you have foreign parties, you'll typically have more restrictions if you're trying to do an outbound tax-free reorg. There's a lot of additional rules you have to comply with. If you've got a seller that just has a lot of net operating losses or something like that, then you might just prefer a taxable deal. So it's really, you have to look at your client a little bit independently of the transaction. You also would want to look at the type of entity. S corporations and corporations, those can qualify under the tax-free reorg rules, but an LLC can't. So if you have an LLC seller, it's not going to be a tax-free reorg. And an S corp, they have some of their own transactions that they can do under 338. So you want to know what type of entity you've got. You also want to consider the shareholders and whether or not they have an appetite for complexity, because a lot of these structures involve a little bit more work. They involve some uncertainty. Certainly deferring tax on something and reporting it that way is sort of a risk in itself. If the IRS disagrees in the future, all of a sudden you have probably what is a really large tax liability from years prior, and a lot of sellers they don't want to face that. And if they think the transaction is maybe on the cusp, they might prefer it to be a taxable deal. Again, also, if you have any questions, just go ahead and stop me as I go. You don't have to wait till the end. So I'm going to dive right into taxable transactions first. You can either have a sale of the assets of the company or a sale of the stock. And a stock purchase is maybe a more commonly used transaction. The sellers, they want to get capital gain, so a lot of times you're selling the stock that they've held for more than a year. You can do that in a number of ways, though, because not every company is small. Any company that has more than 10 shareholders you have this concern, well, will each person sign this transaction? Will they all agree to sell their stock? And so you more commonly see it structured as a merger, even though for tax purposes it's going to be a stock sale. So in this slide, what you have is, the acquirer just sets up a merger subsidiary, and that merger subsidiary merges into the target. And that, for tax purposes, is a stock sale. If you think about it, before the transaction, you've got the target. After the transaction, the target is just wholly owned by the acquirer. So it's the same thing that would have happened in a stock sale, but you don't need to have every shareholder approve that type of transaction. And so that's why people will structure it this way. State law might provide people with dissenters' rights or some sort of appraisal rights if they don't approve the transaction, but that won't prevent the transaction from going through or closing. So a lot of stock sales are actually structured in this way, especially when there's cash on the table and there's a lot of stockholders involved. You don't want to have one person dragging their feet and hold up the closing of a deal. I'll pause and take a moment to talk about Section 382. This is, like I mentioned at the beginning, if a company has net operating losses, you might consider selling the assets of the corporation because, theoretically, they have a loss on their books, they sell the assets and have a gain, they're going to offset that gain with the losses that are on their books. But you want to also know whether or not those losses are available, because 382 limits that. If there's been a change in ownership of the company, which is generally tested over a 3-year period and looks at 5% shareholders and whether or not their ownership increases by more than 50%. So it can be a complicated analysis, but you want to look at whether or not an ownership change has occurred. If an ownership change has occurred, then all the net operating losses that were generated before that ownership change may not be used to offset income to their full extent. There's an extreme limitation on their use going forward. If your losses were all earned after you had the ownership change, then they're fine, you can use them. So you sort of have to track the time periods over which the losses were incurred and compare that to any ownership changes on the cap table. The analysis, like I said, is complicated, and if you have a complicated capital structure, a lot of classes of stock, a lot of different investors over different periods of time, then it's just very difficult to do. I actually try to get accountants to do it, because if we attorneys try to do it and then the accountant disagrees with the complicated analysis, then you've got sort of a problem. As you all know, the accountants are the people who have to sign the returns. So if you want them to be most comfortable with it, in my mind, I think, well, maybe the CPA should do the analysis themselves, because then they'll be the most comfortable with the result. So anyway, that applies, and you want to think about whether or not that applies if you're selling the assets of the company in a taxable transaction, because if you are selling assets in a corporation, if it's not an S corporation, then you're going to have sort of a tax inefficient structure. You've got a corporate gain, that means the corporation pays taxes. You've got a distribution eventually to the shareholders, that means the shareholders pay more taxes, and your overall effective rate is really high. So unless you have these NOLs to offset the corporate gain, or unless you're an S corp and there really is no corporate tax, then an asset sale often doesn't make any sense. And just like a stock sale, there's different ways to do it. You don't actually have to sell the assets of the company, although you often will, because the buyer doesn't want everything that the seller has. They just want to pick and choose what assets they want to buy. So you will often see an actual asset sale. But you could do it as a merger as well. You could do a forward merger, a forward subsidiary merger. The difference here is that the target merges into the merger sub, and the merger sub survives, and that makes it basically, for tax purpose, treated as the same as an asset sale followed by a liquidation. So all these transactions, we're saying, well, there's taxes due, there's consideration paid, but what most often happens is there's consideration paid over periods of time, there's earnouts, there's contingent consideration. Almost never do I see a deal where everything is paid right at closing. So you need to know the installment method rules really well. It helps because anytime you have a payment that's outside of the year, outside of the closing of the present tax year, or the tax year that contains the closing, then you're going to be under the installment method unless you elect out of it. And basically it works kind of how you would expect. The sellers will have a pro rata portion of their gain in each year, and pro rata meaning, in a simple example, if they're selling their company for $100 and they had a $20 basis, you've got $80 of gain, but when do you realize that gain? Let's say the first payment of $75 is made in the first year and $25 is paid in the second year. Because the payments are separated into two chunks and 3/4 of it is paid in the first year, you're going to recoup 3/4 of your basis in the first year. So you've got $75, 3/4 of your basis is $15, you've got $60 of gain in the first year. In the second year, you've got this $25 payment and you're using your last $5 of basis, so you have $20 of gain in that year. And that's generally how the installment method works. If you don't have a maximum amount payable, though, under the contract, then you can't do it quite that same way. You actually would look next to whether or not there's a maximum term over which those payments would be made. Occasionally, a payment will just be made based on future profit of the company in the next year. Because that profit could be anything, there really is no maximum amount. And so you would then look at the period over which the payments could be made, if it's 1, 2, 3 years, and then you would recoup your basis over that period of time, ratably. And if you don't have either of those, you don't have a maximum amount or you don't have a period, because these payments could be sort of continuing on indefinitely. Sometimes I see that when it's an IP deal and it looks more like, it's almost like a royalty. It's some percentage of future proceeds indefinitely. Then you actually have to recover your basis ratably over 15 years, sort of like an amortization. But you want to be careful because that could be sort of a bad result. And now you're taking only a small basis in the first year, and if those payments are really small in all those future years, you're sort of pushing, you're accelerating your income to the beginning. And the taxpayer might not be aware of that when they're signing the deal. They might think, well, I've got a $20 basis. I don't have that much gain. But if they're only using a 15th of that basis to offset their gain, they have a lot more than they think. Another important piece of any asset sale that's taxable is going to be this allocation of the purchase price. And this is in the M&A agreements. It's in your merger document. Typically, the parties will try to agree on a format or an actual allocation. I prefer trying to agree on the means to determine the allocation, because I don't like to try to put the cart before the horse here. Again, it's a CPA at the end. Months after you close, that's when they're reporting the sale. And you don't really want to agree on an allocation that someone is going to disagree with when it comes to filing the returns. So the language I put in most of these agreements says that the parties will, one party will prepare a first draft within 90 days of closing. The other party will comment on that draft and offer their own opinion of what it should be. And then, there's maybe even a mechanism to resolve any disputes, because you want to make sure everyone's reporting it consistently. And if you represent seller, you're really concerned that the allocation matches what you expect, especially in the S corp context. This could affect the character of the gain that the taxpayer is paying. They might have capital gain or ordinary income, depending on how you allocate between these different classes. And so it's important to both parties. It's important to get it right. And so I try to defer it to post-closing and make sure people put enough thought to it that it's done right. And the way it generally works is you kind of take a balance sheet for the company. You take all the consideration paid in the deal, and you allocate it to these different classes. This is required by the code. And if you have any leftover, what I do is allocate sort of book value to the different classes, or assets that fall in the different classes. And then if you have leftover consideration in the deal, it falls into the last category, class 6, and it just becomes goodwill. which is generally good for the seller. That's going to be capital gain at that point. If it's a C corporation, it doesn't really matter so much. You all know C corps don't have a capital gains tax rate. They all pay the corporate tax rate. So it doesn't matter as much in the C corp as it does in the S corp context. Or if an LLC, you go through a similar exercise. But it also matters for the buyer because their amortization schedule might be different for different types of assets. So that's why you have a little bit of a negotiation going on. Buyer might want one thing that's worse for seller and vice versa. So for the time being, I'm going to move into the tax-free reorganizations. The different letters here typically correspond to the sections of the code in 368. So type A is a 368 A1A transaction and so on. I'm going to cover A, B, and C. D is really more of a spin-off provision. I think there are some acquisitive reorganizations using type D, but I don't see them very much in practice. And type D is, if you're splitting up a company, into two different businesses, then you're going to consult that section. But I'm not going to cover that. It's got enough complications in its own that maybe a separate seminar would cover that. Type E is a recap. You're just changing the capital structure of the company. And type F is a migration. You're just changing where the company's organized. And those types of transactions are pretty easy to structure as tax-free. But A, B, and C is what I'll cover in some more detail. So a type A reorganization means a statutory merger or consolidation. That means you have to find a state statute, comply with that statute strictly, and essentially merge one company into another. You've got a list of requirements here on the slide, and I'm going to touch on those because these are common to all tax-free reorgs. And I'll cover them in a little bit more detail later. But basically, you need the main thing that I mentioned at the beginning, which is continuity of interest. That is a measure of how much buyer stock is paid versus the overall value of the transaction. Theoretically, the issue is that the government doesn't want you to defer your gain on a transaction when you don't really have a continuing interest in the asset anymore. If you've sold your company for cash, you've exited your investment and you have to pay taxes. If you've sold your entity but you've got a significant portion of the buyer's stock, your investment is essentially continuing. And so that's why these rules exist, to allow you to defer the gain in that sort of context. And again, we're only talking about deferring the gain on the stock consideration. All the cash consideration you receive is still taxable. So it's really only the stock piece that you're determining whether or not that component is taxable. So the continuity of interest ties into that concept. At least 40% of the transaction consideration has to be paid in buyer voting stock. And that's sort of the current floor. It's based on a proposed Treasury regulation, I think it's proposed. And it's actually created by law and court cases. So there's some other court cases out there that say different things. But basically, most people use 40% as the threshold. Business purpose is required for any tax-free reorg. You need some non-tax reason that the parties are participating in the transaction. Continuity of business enterprise means that the buyer has to continue the historic business of the target, or at least use the historic assets of the target in a business going forward. Can be a different business. You need a plan of reorganization, which is just a recital in my mind. We recite in our merger agreement that this is a plan of reorganization, and you add one sentence and you've met that requirement, so it's a pretty easy one. You also need net value, meaning that the liabilities of the target are not in excess of its value. So like I said, the type A is a statutory merger or a statutory consolidation. I don't think I've ever seen a statutory consolidation. A lot of state laws will actually allow you to do this. You're combining two companies and becoming a new third company. But I've never seen anyone actually do this in practice. And the requirements are completely identical to the prior slide. And then, some of the more common tax-free reorgs are triangular or subsidiary mergers. You've got two general types, a forward triangular merger. In the forward, again, the merger sub survives the merger between the target and the merger sub. And in the reverse, you've got the target surviving that merger. And the requirements for each of them are a little bit different, so you have to know which one you're dealing with. So we'll start with the forward triangular merger. Start with the forward triangular merger. So, like I said, the buyer will set up a new acquisition subsidiary, just a new corporation. Then they'll have the target merge into that merger sub, and that merger sub will survive the transaction. The target shareholders under the merger agreement, they're basically giving up all their stock at the target for whatever is listed as a consideration in the merger agreement. You have all the same requirements that I mentioned earlier. The continuity of interest is 40%. You've got the continuity of business enterprise and those other things. But in addition, under this type of merger, you need to make sure that substantially all of Target's assets are acquired by the merger sub. So you can't, sort of carve out different assets of the target before you enter into the merger. You can't, peel out things and maybe sell them to other parties right beforehand. But assuming you've got substantially all the assets continuing in the merger sub, then you've got a good tax-free reorg. The bad thing about this transaction is if you don't qualify, you've got an asset sale for tax purposes. And that would be, again, 2 levels of tax and not an efficient transaction. And another thing, this is non-tax, but sometimes for corporate reasons, the forward merger is a little bit more complicated because you don't have this target company with all of its relationships and contracts. That's not really, it's going away. It's merging into a new company, and some of those contracts and things might need to be, you might need approvals from third parties, and you might need to rewrite a few things going forward. But, the merger sub survives in that one. So I do see some preference for reverse triangular mergers because of, the fact that the target, lives through it and survives. But with that preference actually comes more requirements. In the reverse triangular merger, you've got a higher continuity of interest threshold because the code requires that the target shareholders surrender control, meaning 80% for buyer voting stock. So your ratio of the buyer stock to the total consideration is now much higher. So if you had a $100 deal that's worth a total of $100, now $80 of that has to be paid in buyer voting stock, not just $40 like I was talking about before. So you've got a higher threshold and a more difficult transaction to satisfy. And really, the parties have often worked out the economics before you even get the deal, and so if there's really not that much consideration that's in buyer stock, it's going to be hard to structure it this way. There's also type B reorganizations. I almost never see these in practice, and that's because it requires 100% of the consideration to be paid in buyer voting stock. No cash allowed. It's a transaction where the target shareholders are just trading their target stock for buyer stock. And, I think you don't see them because there's an easy replacement for them. There's an alternative, and that's the one I just talked about. The reverse triangular merger will get you to the same spot. Because in this one, the buyer acquires target stock. So after the deal, buyer just is 100% owner of target, right? Why not do a reverse triangular merger? Again, it's buyer ends up as just 100% owner of the target at the end of the deal, and in the reverse, you've got only an 80% continuity of interest requirement. So you can still have some cash or some boot in the deal. Like I said, in the B, you can't have any cash in it, and people are even afraid. Like even if the term sheet says there's no cash, maybe someone's expenses are paid, or something that you don't really expect is going to happen that's going to blow your reorg. And so that's why you just don't see a B, I think. You see it as a reverse triangular merger instead. Type C reorganizations are an exchange of stock for assets. So this one is actually more of an asset deal. The target is actually transferring assets for buyer stock, and then the target is actually going to liquidate and transfer the buyer stock in its liquidation to its shareholders. There's a few more requirements in addition to the regular ones here. Again, it's the higher threshold of 80% because it has a similar requirement to exchange substantially all the assets for the buyer voting stock. And so you've got an 80% threshold. You've got a requirement to exchange substantially all of the assets of target. So you can't quite cherry pick them. If the buyer wants to do that, that might not work. And like I said before, the target actually has to liquidate. You typically have a year to have the liquidation finalized. And so that does give you some time to do that. So you do see these transactions sometimes in practice. I think it's maybe when maybe a few things are concerning the buyer about the target, maybe some liabilities are out there that they're a little bit worried about, because again, you're going to end up in a similar place as the other triangular mergers, and again, you have an 80% requirement, so the requirements are really similar to the reverse triangular merger, but in that one you've got 100% of target is coming over. In this one, there's a little bit of picking and choosing. And a common structure that I've seen a lot in the last few years is what's called a double merger or two-step merger. You basically have a reverse triangular merger where the merger sub merges. Well, let me start at the beginning. The buyer sets up two merger subs this time instead of one. The buyer has merger sub 1 and merger sub 2. And the buyer merges merger sub 1 into the target, and the target survives. So you have a reverse triangular merger. And then you take that surviving entity and you merge it into merger sub 2 in a forward triangular merger. And the merger sub 2 survives that transaction. And so you've done sort of a complicated thing, and you're asking, well, why am I doing this? And that's a good question. It's because you want to qualify a transaction that would under a type A reorganization, which is the one that has the 40% continuity requirement. But maybe you're worried that you're not going to qualify. A lot of times the consideration is contingent, there's earnouts, there's escrow. Maybe some of the buyer stock could be taken back in the transaction. I mean, if a lot of times I even see deals where founders, there's vesting terms on their buyer stock, even their deal proceeds. And so if they leave, they might have to give back some of that buyer stock. And now what you had, maybe you had 50% continuity going into the closing and you had it right after, but then 6 months later, someone gave back a big chunk of stock and you've dropped below that 40% line. And now you're concerned that, you didn't actually qualify as a tax-free reorg. And I think the regulations are a little unclear about whether or not those subsequent events, make a difference. And I think people have different opinions about that. But conservatively, I think what the regulations say is that you would consider everything that's contemplated by the transaction. And the transaction does contemplate that forfeiture, right? So why wouldn't you, I think you would sort of group it all together and say, well, at the end of the deal, and yeah, we're looking 6 months later, but at the end of the day, you don't have the continuity met because you've fallen below the 40% threshold. And if you do in a type A reorg, you fall below, you blow the reorg, now you've got what I said before was that tax disaster. You've got taxable sale of assets by the corporation, taxable liquidation of the company, overall effective rate of 60% or something. So the reason we do it this way is because if it blows the reorg, you actually are taxed on the first step, and this is set forth in this revenue ruling, but it's taxed as an asset sale instead of a sale, taxed as a stock sale instead of a sale of the assets of the company. And so you've got a taxable transaction that is just a little bit better for the sellers than an asset sale would have been. And so it's sort of mitigating, it's not really mitigating the risk that you would be blowing the reorg. I guess it's sort of mitigating the consequence of blowing the reorg. And it's not that much extra work to do it. So you actually do see a lot of this in practice, especially when you've got those sorts of terms that could change the ratio of the proceeds going forward. All right, I've got a couple of examples. We'll see if any participation would be appreciated here. So you've got facts where you represent a target, it's a corporation, the buyer wants to acquire the target for 50% cash and 50% buyer stock. And a significant portion of the buyer stock is payable to founders of the target and subject to claims for indemnification and forfeiture if the founders do not maintain employment with the buyer. And so I guess, what would we recommend probably in this factual scenario? Anyone? I'm going to start calling on people because I know some names. Mike, any idea? Okay. Lauren? Art?
I was wondering, suppose you file an 83B election,
Yeah.
which says they own it.
Yeah. Yeah, I mean, that's a good point. That's the other argument that I've heard, that people say, well, you filed this 83B election, you've sort of changed the nature of that consideration, and people cite that same revenue ruling that says, well, in this sort of transaction you filed the 83B, it's 2007-49, they say, well, somehow this says that you own this stock and this is not going to bear on whether or not the transaction qualifies as a tax-free reorg at that point, or whether it meets the continuity of interest. And I've seen that people take that position. And like I said, I think the regs are a little bit unclear. I think conservatively, you'd rather just do the double merger. I mean, so that's the answer. It's double merger so that, if it is taxable, or if the government says it is at some point in the future, at least what you're arguing over is a little bit less than, than a taxable sale of the assets of the company. And we'll talk about that 83B election a little bit later. It's a good point.
What is a significant portion?
Oh, well, anything that would cause you to go under that 40% threshold. So if you've got 50% now, and let's just say the founders are really substantial owners, so there's a chance that you could fall down to 25%, something like that. And anything that would push you below the threshold. And oftentimes we actually prepare like a spreadsheet and do the math. We say, well, is there any factual scenario here that we're aware of that under these agreements would cause us to fall below 40%? And if there is, then it's a prime candidate for the double merger. A lot of times you can do that math and you can say, well, even if we gave everything back, we're still above 40%, then you're okay. All right, we got another example. I expect more participation this time. So again, you represent the target, it's a corporation. The buyer wants to acquire the target stock for 10% cash and 90% buyer stock, and the target is worried that it cannot obtain consent of 100% of its shareholders. And so what sort of transaction does this seem to fit the bill for? Art, yeah?
Probably the reverse triangle because you're over the 80% threshold of the triangle.
That's right. That's exactly the right answer. You've got more than the 80% continuity of interest threshold. It says here the buyer has, offering 90% of the consideration as a buyer stock. You don't want to get, all the shareholders to have to sell their shares, and so you're going to end up with a merger. That's what the last fact is about. So you're probably going to end up with that reverse triangular merger. I'm going to go into the requirements a little bit in a little bit more detail. Here's a quick list of them all. And I've already talked about continuity of interest for a little while, and I think it's one of those major considerations here. But here's some of the law. For a long time, people thought 50% was the threshold. There was a safe harbor and a revenue procedure from 1977. Then, like I said, in some temp regs that were issued, I want to say within the last 10 years, maybe in 2008 or 9, I don't remember exactly. They came out with, the IRS had an example in the regulations that said, essentially under these facts where 40% was part of the facts, they said, well, this has sufficient continuity of interest. And if you have, a position from the IRS, you're sort of comfortable that they're not going to challenge that when you meet that 40% threshold. You've got a couple older court cases that have gone to lower amounts. 16% in an old court case was clearly insufficient. And so, like I said, most people sort of stick with the 40%. I think I've seen a few tax opinions from big, accounting firms that might come out a little bit lower than that. If it's really close to the line, the target might go get a tax opinion from someone that says, something else is okay still too. But yeah, I don't know. I don't know why you would take that risk. I think it might be better to just adjust the consideration a little bit and try to get to a transaction that does qualify clearly. There's some regulations from 2011 that also talk about the change in value between the closing and the signing, because theoretically that could happen. You've signed an agreement, you've agreed a certain amount of stock of the buyer is going to be paid and a certain amount of cash, and then the value of the buyer changes, but before you have an opportunity to close. And what these regulations help you do is, it fixes that date for the analysis of continuity of interest to the day. I think it's the day after, the last business day before the contract is binding. And so you're not really subject to those changes in value that might occur before closing. There's some other things in those regs too, they're kind of complicated. Another item that's related to the same issue of continuity of interest is non-qualified preferred stock. So I'm always saying that this requirement is for buyer voting stock. But what if the buyer voting stock the sellers are receiving gives the sellers the right to have it redeemed at their discretion, and essentially receive cash whenever they want. And the rules don't treat that the same as any other buyer voting stock. The rules would treat that as cash. And so you don't count that sort of stock when you're determining whether or not you meet the continuity of interest requirement. This slide is about, sort of what we've touched on a little bit about escrows and earnout, but it's really about how continuity is met with respect to those items. If you've got, a part of the consideration going into an escrow, then you want to make sure often that if that includes stock of the buyer, that you get to count that for continuity of interest purposes. Do you count that as stock that, into the 40% analysis? And the answer is typically yes, so long as you give the shareholders, the sellers, the right to receive dividends and vote that stock. Even though it's held in escrow by the buyer, you give them those rights, and then for tax purposes, they're the owner. And it counts as good consideration for continuity of interest. So you just want to be careful of that. If it's like an earnout, where they're only going to be granted stock at some point of the future, you typically won't count that because it's not granted yet. So you have to be careful about which items you're considering in your analysis. So the other requirements are not as significant as continuity of interest, but continuity of business enterprise is, I'd say, one of the next larger ones, because it's actually something that the buyer controls to a large extent. Again, the requirement is that the acquirer continue the target's historic business or use a significant portion of the target's historic business assets in another business. And if you simply sign an agreement that you believe is a tax-free reorg, but there's no requirement for the buyer to do any of these things, then you have this uncertainty that the buyer, 10 days later just sells all the assets that you had just transferred to them, and now you don't have this continuity of business enterprise requirement satisfied. And so you'll see language in a lot of merger agreements that actually addresses this and tries to put a covenant or a representation that the buyer intends to do to satisfy this requirement. And then business purposes on this slide too. Again, it's just a substantial non-tax corporate level purpose for the transaction. It's not typically a disputed item in most M&A deals that are between unrelated parties. I'd be more concerned if you have related parties and it just looks more like some sort of tax avoidance scheme. But most of the deals I work on are all unrelated parties. So the next requirement is the net value rules I mentioned. It's in these proposed regulations from 2005. They basically say if there's an exchange of no net value, meaning the liabilities of the target exceed its value, then you don't qualify as a tax-free reorg. This is just kind of a hidden rule because it's not in the code and it's in these proposed regulations. So it's one of those things that you just want to keep an eye on. Like I said before, you need a plan of reorganization, which you just add a recital to your merger agreement and you're typically covered. There were some court cases from the past that are even more flexible than that. You've got, I'm sorry. Yeah, they often didn't even require a written document. 2007 regulations from the IRS basically require each company to adopt a plan of reorganization, each party to the reorg. And like I said before, so there were the basic requirements that all the reorgs have, and the continuity of interest is 40% of that in the basic concept. But then there's special tests for certain reorgs. Like I mentioned, Type B reorganizations have the no cash requirement. This is just sort of a summary of all those special requirements that certain reorgs have. So Type A is not on here because it doesn't have anything special. You really just have the basic requirements. In Type B, it's no cash. You have to surrender control. Type C, you're up to the 80% requirement for continuity of interest. You also have to transfer substantially all of the assets and liquidate. In the forward triangular merger, you have to transfer substantially all of the assets. And in the reverse, again, you're up to the 80% requirement, and it's pretty much the same as the Type C. SEP transaction is, again, not really something that we worry about too much in a deal. It's the concept that the IRS might look at a transaction with several steps and then integrate them into a more simple transaction that has a different tax result, obviously, than the one that you took. The areas that I see this are, maybe if a company is an LLC now and they want to try to be involved in a tax-free reorg, would they incorporate and then shortly thereafter have a tax-free reorganization? That kind of looks like that first step of incorporating. Maybe that gets collapsed with the transaction and the step transaction type of argument. And as a whole, really you've got a company that was an LLC before, and after the deal is, they've done a tax-free reorg, so an LLC couldn't have done that. So you could have potentially a problem there. A variation of that would be to have the LLC elect to be taxed as a corporation instead of actually incorporate, which you could do under the check-the-box rules. And I think people feel a little bit more comfortable about that one than actually incorporating. I think it has some risk, but a lot of people think that the check-the-box rules have this sort of, I don't know, they're sort of respected in and of themselves, and so people believe that first step is respected separately if you do check the box. A quick overview will cover the consequences to all the parties of the deal. Well, the buyer in these tax-free reorganizations is just going to take a carryover basis in either the assets or the stock they're receiving. You would increase that carryover basis for any gain that the target or the shareholders recognize. Again, there's NOL limitations would likely apply to, if they acquired a target that has NOLs, because the transaction itself is likely a change in ownership. The buyer doesn't really get to use those going forward. Loss importation is more about when losses, we're not subject to U.S. tax in the hands of a transfer before the transaction, but then this transaction somehow brings these losses into the U.S. and taxpayers take advantage of them. It's sort of loose rules to prevent that is what I generally describe them as. I'm going to go through some of these quickly because we're getting towards the end of the hour and I want to make sure I cover certain things. So the target, again, in these tax-free reorgs, the target itself typically doesn't have any gain or loss to recognize at the corporate level. You could even have holders of target debt securities exchange those for securities of the buyer in a tax-free transaction, and they would not have to incur gain on that. There's always some risk that there's COD income, though, because you're comparing securities to securities, and if there's any debt relief, then you might have some COD income. Target shareholders, again, they only recognize gain on the cash they receive. If you qualify as a tax-free reorg, you don't recognize the gain on the stock portion. A loss in a tax-free reorg cannot be recognized. And then again, you typically have, the type of gain that they do recognize on the cash portion is either capital gain or dividend. It's not that big of a difference these days because the rates are largely the same for those two categories of income. You might have a difference if a taxpayer has a lot of accumulated capital losses, and so that particular taxpayer prefers capital gains to dividends. But for the most part, it doesn't really matter. If you want to, if it's a real issue and it's one of those transactions that's on the borderline, you sort of determine whether or not the cash portion is a dividend or capital gain under the normal rules under 302. So you look at whether or not they're giving up a substantial portion of their ownership. In most of these M&A deals, they're giving up all of their ownership. And so you've got what in most cases will be a capital gain. I guess in rare circumstances, it might be properly classified as a dividend. That issue actually came up unrelated to tax-free reorgs, but in the QSBS context. I have a client who's sort of in an audit about that issue. It's like, was the transaction, did it include a dividend or a redemption, which brought his basis down? And when you bring your basis down, now your limit on your QSBS gain changes, right? Because the QSBS it excludes gain up to the greater of $10 million or 10 times your adjusted basis. In this case, the taxpayer actually had a large basis. But if there was a redemption included in the deal and it wasn't all, just purchase price, then that redemption would have decreased his basis and brought down his QSBS gain exclusion. So it's important in that context too. And largely, I'm not really covering QSBS, but it's certainly something that occasionally crops up in these deals. And if you know your clients are sensitive to that issue or they expect, to qualify under QSBS, then you want to look into those rules too. Foreign corporations, just touching on those, again, it's generally the same. You can do an outbound tax-free reorg. The foreign buyer is buying a domestic company and offering some of the foreign buyer's stock in the deal, and the requirements are similar. But you have more strict requirements. Generally, you've got to have any significant U.S. transfers enter into gain recognition agreements. The U.S. transfers, can't own over certain thresholds of the foreign company after the deal. Because if it's really, more of a related party transaction where all the sellers are going to own this foreign entity afterwards, and they own a really significant portion, it almost looks like some sort of migration out of the U.S. And in those types of cases, you've got 7874 and 367 will cause those to be taxable deals. And could even, the next slide is about 7874. In some context, if the target shareholders end up owning more than 80% of the foreign acquirer, then actually those rules say that you just continue to treat the foreign acquirer as a U.S. corporation, even though it's a foreign entity. And so that'd be a pretty bad result. And I know there's been some talk about even revising these rules and making them worse, but they're already sort of a layer on top of everything else that doesn't really mesh with everything else all that well. But they could get even worse, I suppose. So this goes back to the issue that Art raised, which is, you have founders selling their target stock, and a portion of the buyer stock they receive is subject to vesting. And that's common. I see it a lot in deals. You do want to make sure that the parties are consistently reporting that as actual transaction consideration. You want to make sure the seller's getting capital gain. Sometimes the buyers will think that it's compensation. It really, in my mind, it depends more on whether or not it's a pro rata payment to all the shareholders versus single payments to individual service providers. So generally, if you have a pro rata, you're pretty comfortable that it's going to be transaction consideration. But even when it is transaction consideration, you want to make the 83B election, because this revenue ruling says that, essentially when you're exchanging fully vested stock for unvested stock, different stock than what you already own, then an 83B is required to avoid, the compensation that you would have on the future vesting events. What the ruling still says, though, is if you were exchanging, maybe it was just not in the M&A context, but you were exchanging your vested stock for unvested stock in the same company, like you already had the vested stock, and maybe a new investor comes in and says, well, we want to unvest you. In that context, this actually says that 83B is not required. I think a lot of people still file it anyway, though, just in case, because there's almost no harm in doing so. There's no additional gain that gets reported due to the filing, and so you're just sort of taking a conservative approach by filing it in case the IRS were to change its mind later. Stock options also have to be dealt with in any M&A. You've got, optionees, NSOs, ISOs. What do you end up doing with those in an M&A deal? The buyer can certainly assume them or substitute them with buyer options, as long as you're not really modifying them and preserving the gain that's inherent in those options. Then you can do that in a tax-free way. You can cancel the options for cash. If you cancel an NSO or an ISO, that's going to be subject to employment taxes. You sort of run it through payroll, that sort of thing. So there's a little bit of a planning opportunity here, at least for people who own ISOs. Because if you exercise an ISO before the deal closes, that exercise, as we all know, it's not taxable for income tax purposes. And the employer doesn't doesn't withhold, doesn't pay employment taxes. For AMT purposes, yeah, they might have gain and they might have taxable income. But for employment, there's no employment taxes paid is sort of the main point on the ISO exercise. And then even when you sell them a couple days later, it's a disqualifying disposition, and you don't get any real benefit. It's still short-term capital gain. But even on that disqualifying disposition, there's no employment taxes, there's no withholding. And so you might be able to get these ISO holders out of 5% tax, because the employment taxes would be due if they simply cash out their ISOs for the consideration in the deal. But, it does complicate the cap table a little bit, though. If you've got a lot more people exercising ISOs and now you've got a lot more shareholders, the corporate attorneys might not like that, and the buyer might not like that either. 409A, it's deferred compensation. Sometimes you see it in these deals. Sometimes, you just have to keep in mind that there could be, disclosures that you have to make. Almost every company is going to, require you in an M&A deal to make a representation that you don't have any 409A problems. So it can come up in that context in terms of representing a target and making those disclosures, and sometimes trying to correct these items. If they haven't been getting option valuations for their option plan, they haven't been getting those formal appraisals. A lot of times we see buyers come in and try to unwind those grants or force them to get some sort of appraisal or something like that. So 409A can present some issues. And you also have to be careful that the buyer doesn't have a 409A problem in some of the comp packages that they're offering to the sellers. Because a lot of times these people negotiate pretty creative things in the context of an M&A deal, maybe outside of the ordinary practice of the buyer. And you just want to make sure those payments are not subject to 409A or comply with it. And the last topic here is 280G. This section is basically a provision in the code that's trying to protect shareholders from the management of the target. I guess in any M&A deal, the management is more involved in negotiating the transaction. And they might negotiate a transaction that has less purchase price and more bonuses for management, right? And so once you're over a certain threshold, these rules kick in, and they essentially require you to consult the shareholders of the company when you're doing that and actually get their approval if you want to avoid an excise tax. And so generally, it's a tax paid, an excise tax could be paid on compensation payments that are tied to a change of control if they're over a certain threshold. The threshold is typically 3 times the average annual compensation for the last 5 years of certain people who are called disqualified individuals. And those individuals include officers, more than 1% shareholders, and the most highly compensated individual, most highly compensated 1% of individuals of the company. Often that's just one person. But all those people, if they're getting these sorts of management or bonus payments, you have to be concerned that 280G might apply. And the way it comes up in practice is there's a rep in the agreement that the buyer makes, the seller rep to, that says that they're not paying anything that would be subject to 280G, and there's no excise tax due. And also, what I forgot to mention is that if a payment is subject to 280G, it's over that threshold. Not only do you pay the excise tax, but the payor, whether it be the seller or the buyer, whoever's making the payment, they don't get the deduction for that payment either. And so the buyer and the seller are both interested in making sure it's complied with, and the buyer might be making a lot of these payments post-closing, so they're often really interested. So you have that rep in the agreement, and for that reason, you have to make sure that you're satisfying the requirements. And part of it, though, is that if you happen to be above the threshold, as long as it's a private company, you can have the disinterested shareholders, by 75% of them, if you have them approve those compensatory payments with sort of full disclosure and knowledge of what they are, then you are now out of the excise tax and out of the loss of the deduction. So you can get this approval to essentially force you to qualify even if you're above the threshold. And it's a task to determine whether or not you're above the threshold and then actually to disclose all that information to the shareholders. But nonetheless, people undergo that exercise quite regularly. Tim Coxon was on the schedule to speak with me from our firm, and he actually gets really involved in 280G. He does the spreadsheets regularly. He can determine whether or not you're above the threshold, whether or not the consent is required, and he helps me on that front. He's really good with spreadsheets, so it's something we've done a lot of over the years. And I'd just say lastly that in 280G, there's a big exception for S corporations and corporations that qualify as S corporations. You don't actually have to make the election. But if you're a type of entity that could make an S election because you have one class of stock, you don't have entity shareholders, those sorts of things, then you're out of 280G. You get a pass. So that's an important thing to keep in mind. You might just not have to deal with it.